Hi, the market and the economy are in scary, uncertain times. I just want to make sure you know what moves you should be making to protect yourself, your team, your family, and most importantly, take advantage of these new emerging opportunities. So, what I want to cover here over the next several minutes is just a distillation of hours of conversation, expert commentary, review, analysis, and we are in a recession. Even though the National Bureau of Economic Research says not yet, yeah, we are really there. There's more shocks coming, and we're going to watch this whole thing play out in real time. So, kind of like the slinky here. When the market goes up, it's great, but when the market craters, well, that's what's happening right now. I mean, the S&P is down 23%, Nasdaq down 31%. The stock market darlings have been just gut punched. I mean, Apple, Google, Amazon, Tesla, Facebook, Netflix all dropped, and that has panic selling ensued. Crypto markets have dropped nearly 2/3 from their highs a year ago. The bond index is down 12%, and the yield curve between the 10-year and 2-year treasury is inverted, meaning people take less money for long-term investments than short-term, and that has always resulted in a recession in the past. The Federal Reserve, aka the Fed, printed money to the tune of about $5 trillion since COVID, and now they're removing $95 billion a month out of that. A lot of that COVID stimulus money went to investing in the market and in savings, not spending that spurs the economy. That led to the stock market bubble, that led to prices rising, which means inflation now at over 8%. The Fed's doing historic rate increases from 0 to 3%. That's the largest in 1 year increase ever, and it could still go another percent higher. So to help you understand what's really happening here and what causes that, you can picture like 6 different dominoes, right? You can have capital, business growth, jobs, stock market, consumer sentiment, and real estate. Those are the 6 dominoes that we want to see if they're going to each get knocked over and knock over their next. So the very first one there, business growth requires access to capital. And that's why the Fed's been raising rates, because it has a downriver impact on the economy. That access to and cost of capital, aka borrowing, is that first domino that affects the second, which is business growth. So as that business can't get as much money, depending on that growth or decline of that business, that means they're going to be laying off people. Since most companies are private, the best public measurement of that really is the jobs or unemployment reports. So as those jobs numbers, which are the third domino, that then drives the stock market. And that's the fourth one, is fixated on that jobs number. So again, that domino number 3 is because it's that jobs number is how we know if the economy is getting bigger or contracting. The stock market's a lagging indicator of what's happening in real time, but then it becomes a leading indicator for consumer sentiment, which is number 5. So the media gives us all these bad reports of layoffs, plummeting stock market, crypto craziness, and then the consumers go, holy crap, everything's bad, fear sets in, spending slows. And so now we know we're in the change of that consumer sentiment, and it's already happened, and we're way downriver to really take any action about it at this point. So finally, we see the effects in the real estate market, and that's domino number 6. And that takes a while for that demand to really kind of fix itself, because you remember when your neighbor sold their house for so much more money, I don't want to take that lower amount. But then people start realizing, hey, it's a different market. And with mortgage rates over 6% now, heading to 7 or 8%, it's a very big difference. So right now we're between that domino number 5 and 6, and we're seeing the effects on the stock market, financial markets, real estate markets. There's still probably more to come. It's going to be bouncy for a while, and now consumers are starting to feel that burn even more. And we see a massive spike in consumer debt. That's really a worrying trend, because people went on an entire year without spending any money, and so they were saving money. The government sent out all this free money. They were having fun doing all those trips and doing different things after they piled up their money in the crypto and everything else. Well, those lifestyles got used to where they're at, and now that those crypto dollars have gone away, those the stock market money's dropped a bunch, and now plastic credit cards are jumping. They jumped $46 billion in the second quarter. That's the highest since 1999. So what I learned ago the hard way is facts don't cease to exist just because you ignore them. So again, if you keep all this in mind, where there's chaos, there is opportunity. Write that down again. Where there's chaos, there is opportunity in downturns. there's usually like a 90-10 loser to winner ratio, which has been proven over and over. 90% of the businesses get hammered or go bust, while 10% boom. I mean, Microsoft started after a recession in the 70s. Apple surge became after 9/11 economic downturn. Netflix started a streaming service right at the Great Recession and with 0 subscribers. So the key points I wanted to help you with is that there are 3 things that really make the difference between whether or not you end up on the 90% side of the ledger or hopefully that 10% where you do a little bit better. So through this volatile time period, there can be a lot of opportune period that can be really good for the next 1 to 2 or 3 years. So there's a couple pieces of advice, and you might want to write these down. So the very first one is protect the downside. Consider an extreme bear case for your industry, for your family. Update your LinkedIn profile in case you need to change jobs. Watch your debt. Make sure you're not over leveraged. Make sure you have enough credit lines and credit card lines just in case of a layoff. One big thing is foundational assets. If you're retired or you're going to be retired soon, make sure you have some foundational assets. These are assets that are principal protected, on average earn about 4 to 8%, and they can't lose principal. And these can be your go-to source for lifestyle and income. And especially in times like this is where a lot of our clients are getting their funds from. And get out of those bonds as soon as you can, because those interest rates are going up again. So again, foundational assets. The next one is steady income assets. These are low volatility assets that pay great dividends. They have cash flow that helps prevent you from having to sell shares at a down market. They can give you cash flow while you're working or retired. And then next up, stop losses. If you have a stock that you've got a lot of money in, maybe have a stop loss where it triggers it and sells it if it drops too much, but that may be a little too late. So once you've protected that downside, what you want to do is look at the tax benefits. Roth conversion is a great option right now. If your IRA is 20% lower than it was before, hey, convert that to a Roth IRA. The downside is you do have to pay the tax now, but it's before the tax rates go up in 2026. But you're also doing it before the market recovers. If the market goes back up that 20%, that comes up on the tax-free side. Another one would be tax loss harvesting, selling some of those assets that you have gains, and then you can even buy them back after 31 days if you want to avoid any wash sales. So I know it's a little bit more technical, but ask us about that. But one of the last one here is really being what Buffett said: be fearful when people are greedy, and be greedy when people are fearful. So this might be the time when you want to be greedy. Now, this takes a little bit more guts, for sure. It may be very bumpy too, but if you have some money in safer assets, you have some money that is on the sidelines, and you got at least a 5-year timeline, well, take some of that money, jump into the market. Something diversified. Don't bet on necessarily one company because that may be too much risk, but do something diversified. And history shows us that over 5 years after a downturn, usually you're going to be coming out very nice and probably making a lot, hopefully. So again, that's a little bit more gutsy. You have to make sure you have enough timeline. Don't just go in and just jump in the market for nothing, right? So what else? Well, stop watching the news, the social media posts, the depressing stories. Spend times with friends, travel, go outside, do anything that you like to do for fun. If you're a client of ours, we already have you protected and diversified. This is why we have those foundational steady income assets in your portfolio. Feel free to reach out to us if you got any concerns or worries. I do actually have this crystal ball here, but I've never been able to figure out how to turn it on. So I know that there's going to be some more chaotic stuff over the next 6 months to maybe a year. But I also know that if you miss a few days of the stock market, it can have a massive negative effect on your portfolio. So it's not a matter of just jumping out, no place to go. If you have some money that you want to have in there, because this is the price to having that market growth, is having some of that market pain. But again, you want to make sure that you've got everything well diversified. If you don't have a plan, oh my gosh, this is a super scary time for you. I would definitely get a plan soon, sooner than later for sure. And so if you need help with that, feel free to reach out and we can help you with that too. So thanks for listening. I hope you go out and just have some fun stuff. Don't worry too much, and know that this will recover over time, just as long as you've got a plan and you're well allocated. So thanks so much.